Hello everyone, how are you all doing, my AFM students? So as you can see, the time now is 9:33 a.m. in Oman, Muscat, right? And I'm recording this now. You can see the screen is blank. I haven't written anything today because I'm going to work on the screen because I want you to understand this perfectly. The interest rate swap perfectly so that it goes to your head, right? And you never forget swap, interest rate swaps. I'm going to do two questions, right? Solving interest rate swap, because that was the last part which was left, which I couldn't cover in part 3, which I'm going to cover in this one, right? So let's go. Also, throughout the end of this video, we are going to learn how to value the interest rate swap and also some exam techniques, right? So now let's go. Let's start. I'm exactly going to take the same question from your BPP textbook, page 481, right? So there has been two company, right? Uh, 1 and 2. There are two company, right? One is good credit. So when I'm explaining this, you can even go to your textbook and see whether you can understand or not. And the second company is the second tire. Okay, so the first company is good credit. Second is second tire. Yes, and the situation is this, that one wants to borrow at variable and one wants to borrow at fixed. Which company wants to borrow, right? I will also tell you, not now, after some time, when in confusion, which like they don't tell clearly, right? Most of you ask me this question that in the revision, sorry, in the textbook and all, like they mentioned that they want to borrow at this rate, so we know that they're going to swap at this rate, right? But under the exam condition, they don't tell you such. They just give you the rates, right? Fixed and variable. Under that condition, which rate to take for swap and which rate to take not to take for swap. So that question, that doubt also I will solve, right? First let's take this example, right, where they have mentioned that good credit, he wants to borrow at what, wants to borrow at variable rate or floating rate, and second tier wants to borrow at fixed rate, right? So with swap, they want to, this is without swap, they want to borrow, right? They want to borrow. Now we'll show you that how whatever they want to borrow, right? Let's say a company, in this case, good credit wants to borrow at variable and second time wants to borrow at fixed. At the end, you will see that they will end up paying that rate only, whichever rate they want in the beginning. At the end, they end up paying that rate, right? So the first one is, we have to make a table, right? So make a table, this and this. So this will be for, I will be writing all my description in the first column, so I will just keep it, and this one will be good credit, right? This one will be second tier, and the third one will be the sum total. You need a third column where you will be taking the sum total. Don't forget to take your sum and total, right? So, and whenever you draw a table, please make sure you use a ruler. Be professional, right? It should not be untidy, just with free hands. Use rulers, bring your rulers, take rulers. It should be neat, right? Even my line somewhat looks neat and straight, even without ruler. You can see how much, I care about neatness and tidiness. So, the first line which you have to enter is without swap, right? Without swap, good credit is variable. This one is fixed, right? Let me write it V and F, right? That's what they want. Now I will write the rate. So the variable is LIBOR, right? And it's a payment. So it will be in the bracket. Always put the payment in the bracket. And receipt has to be without brackets. And this one is fixed and they have given the rate is 12.5%. I have done this working even before. You can check my before videos if you want. But this is again, I want to start fresh because I quickly want to refresh. Like this is the last minute revision of interest rate swap. Because interest rate swap doesn't have too many questions, just one or two questions to solve, we will understand. Okay, now what you have to do, for sum total, add both the LIBOR and 12.5%. This is also a payment, so it will be in bracket, right? Always payment without bracket, payment in bracket. So LIBOR plus 12.5%, and the whole thing will be in bracket. It actually makes a sense, right? It matters a lot. You might be thinking that it's okay, the rate is correct. If I don't put bracket, they will understand. No, they will not understand, because later when you swap, you are also going to deal with the receipts and payments. So you need to put in bracket, right? Until you don't come to the swap, everything is in bracket except that gain. Right now comes with swap. So the second line will be with swap. With swap will be what? Without swap, good credit is going for variable. With swap means he will go for fixed rate. It has to be opposite, right? Without and with swap. So now he will be paying at 11%. Again, this is a payment, it will be in bracket, and this one will be paying now at variable. LIBOR plus, because in the question it has been said so. I don't have the time to write the question, so I'm just doing it. Okay, now add both 11 and LIBOR plus 0.5. It will be LIBOR plus 11.5%, right? Now what do you have to do? The gain. The gain you don't have to take separately for each, right? Whenever you go for a gain, always go to the sum total. From that total, you have to take the gain. What is the gain? When you take the gain, it is the difference between without and with swap, just minus both. So LIBOR gets cancelled. 12.5 minus 11.5, 1%. 1% is the gain. Now this gain, right? They will tell you, right? They might tell you or they might not tell you. They might tell you that the gain is divided equally between the two parties. If they don't tell you, even if they don't tell you, you have to take it equally between the two parties. Right? The gain should always be divided between the two parties equally, even if they don't mention in the exam. But if they mention, you anyway have to take. So split the gain. Now the gain will be splitted, okay? Just follow my workings, because the same working you have to do in the exam, the same manner, the same way, same order. The only thing will, the numbers will change, that's it. Only the numbers will change, even the variable will remain live, right? So split. Now 1%, it will be 0.5 and 0.5. As I told you, it's a gain, so don't go and put your gain inside the bracket. It has to be positive, right? Without brackets. Now what is the expected outcome? Very important is the expected outcome. This needs to be there. Every line which I am putting, every line needs to be put as it is. You cannot skip one line and go to the next. Without swap, with swap, gain, split gain, expected outcome, everything needs to be there in the proper order, right? What is the expected outcome? Expected outcome when you calculate, right? I am writing numbers here. 1, 2, 3, 4. That 3 is for that 1% and 4 is the split gain. And this is expected outcome is 5. I'm putting numbers so that when I tell 1, 2, you should be able to understand which line I'm talking about. So expected outcome is without swap. That's number 1, right? Minus the gain. Gain is number 4. Gain for individual, right? For individually you have to take. That means without swap, for good credit it was LIBOR and the gain was 0.5. So LIBOR minus 0.5. That is the expected outcome. And same way for second tire, without swap it was 12.5 and the gain is 0.5. So 12.5 minus 0.5 is 12%. Now take the total of LIBOR minus 0.5 plus 12. That means 12 minus 0.5. LIBOR will be there. So LIBOR plus 11.5%. Right? It should be in bracket. Everything else has to be in bracket. Now let's go to the swap terms. Right? I need to extend this line more. Swap terms. Whenever swap terms come, okay? First, what you have to write is this. With, okay? With swap, which interest you are paying. Or you can say with swap. What is with swap? What is the number? Number 2. You could say with swap. It will be the same only. So it will be 11%, right? Because now you are paying interest on the one with swap, right? Go. I'm sorry. So with swap, and here it will be LIBOR plus 0.5%, right? With swap you have to take, okay? I'm repeating. Don't go and take the first one without swap, right? So here it will be LIBOR. I'm sorry, this is B plus 11.5% again in bracket, right? Now swap floating, swap fixed. There's a way to check. There is also a way to check whether your swap, the amount which you have swapped, the floating and the fixed, is correct or not, right? So swap floating. Always whenever you have to swap, start with floating, okay? Don't start with fixed. You cannot get with fixed. Fixed is a balancing figure. That's why I will write balancing amount, okay? Balancing. That is the balancing figure after everything. Filling the blank. For that filling the blank, you need fixed. But floating, you can swap. Why? Because floating, you know, is LIBOR, right? That's why we can swap the floating. Now, for sweating, right? Let me. I think I need to extend this line more. Wow, I think I dropped pretty straight line, right? Not bad without ruler. Proud of myself. Okay, so what was the expected outcome? Number 5, right? Here also you have to get the same expected outcome. Right? Your expected outcome has to be same. Or your net pay, you can say. You can say net pay. It has to be same as number 5. That's why I will show number 5 here. Same as expected outcome. So it will be LIBOR minus 0.5. Whatever you do with swap, all the time remember, your end result has to be, you have to get that expected outcome. Right? That is the whole purpose. If you don't get that, then somewhere you are wrong. So now, when you are floating, right? Just check. When you have to swap floating, you know it's LIBOR only, right? But which company has to pay, which company has to receive? This question comes to your mind, right? So when you have to see, check your net pay or your expected outcome, both are same only. Check in your net pay which company has having LIBOR as a payment in the answer. Is it good credit or is it second tier? The first company or the second company? I can see first company is having a LIBOR minus 0.5%. Second company is only having 12%. There is no LIBOR in this second company. That means first company is the one who is going to pay. You can see the LIBOR inside the bracket. That means first company is going to pay, second company there is no LIBOR. It's only 12%. That means second company is going to receive LIBOR. Right? So first LIBOR he is going to pay, so it will be in bracket. This company is going to receive LIBOR, so no bracket, right? So because you can see number 2, pay interest on loan, right? That is with swap, right? You can see it's LIBOR plus 0.5%. So that LIBOR, the first LIBOR plus 0.5%, that is inside the bracket. It's a payment, and the after swapping, you are receiving LIBOR. So you are paying, you are receiving, it is getting cancelled, and at the end you are just having 12%, right? So you can check that way. Now let's go to fixed. Now fixed, when you go to calculation for fixed, start from the company which is paying in fixed rate. That means this is paying in fixed, right? You can see 12%. So start with the second company. You can balance it easily because LIBOR is cancelled. You are only having what older this rate, older 0.5% is there out of 12. So it's easy. 12 minus 0.5, the balancing figure is 11.5%. And it's a payment. This is a payment. It will be in bracket now, and that's why this is in receipt. It will be the same amount, right? Payment and receipt, one company is paying, receiving, one company is paying. That is it, but the amount will be same, right? So payment will be in bracket, receipt will be without bracket. Now we'll check, are we getting the right answer or not, right? You don't have to, no need, that's why I'm putting line, no need to put anything in the total income. We just want to see, are we getting individually. First we'll check for the first company, good credit. So this one, right? 11% plus LIBOR. So LIBOR plus 11% minus 11.5, right? So 11 minus 11.5. So it's minus 0.5. Yes, we are getting LIBOR minus 0.5. Second, just check. LIBOR plus 0.5. Okay, that's payment. Then we are receiving LIBOR. LIBOR gets cancelled. So we are only paying 0.5, and now we are paying fixed 11.5. So 11.5, 0.5 is getting 12%. That means we are right. Right? This is net pay. And how much you would pay without no, without swap, just check without swap, right? This is how you have to check. Without swap, that is the first one. Just I will go up and show you. LIBOR and 12.5%. So now when you want to take the difference, that difference will be the gain. That difference will be your gain, and your gain has to be same. You have to get 0.5% gain. LIBOR gets cancelled, you only having 0.5%. Right? When you minus, you have to minus from down. Without swap, minus your net pay, right? So 12.5 minus 12%, so 0.5. So 0.5, 0.5, 1% gain. It's correct. Correct. This is correct, this is correct. Now you know it's correct because you are getting the gain. even if you don't have to come to till gain. I just wanted to show you. Okay, main thing is your net pay, your expected outcome has to be same. That's it. Once your expected outcome you get after swap terms, it's correct. Now I'm going to do a second question. So this question is solved. Please comment me below if you haven't understood that question, so that I can come and approach you and explain you in a much easier way if you need help on swap, interest rate swap. Right now, let's go to a second question. Okay. Now I'm going to Now in this question I'm going to show you that we don't know whether they will pay in fixed or variable. Question will not tell you. We have to find out at what rate they will swap. Under the exam condition, what you have to do, I'm going to show you now. Right? So let's take very easy company A and company B. Okay. And this is the sum total. So there are two companies, right? And we don't know at what rate. In this condition, this is the exam condition. You don't know which rate. So in that condition, just write fixed rate of both and variable rate of both. Fixed, variable, or floating. Fixed rate, right? So fixed rate of both you write. Here, in this case, the fixed rate is 9%. And this, it is 10.5%. Right? When you go to variable, here it is, for LIBOR I'm writing L, right? L plus 0.75%. And here the variable rate is L plus 1.5%. Now you have to find the difference. You can see, when you see that under both fixed and variable rate, A is paying less, right? Because A is paying 9%, whereas B is paying 10.5%. A is paying L plus 0.75, whereas B is paying L plus 1.5. So you can see in both conditions A is paying less, fixed and variable. That we know. But another doubt is in which rate they are having comparative advantage. That is the rate where they have to swap. So just find the difference between the two fixed rates. 10.5 minus 9, 1.5%. 1.5 plus 0.75, right? Because L will cancel. It is 0.75. So which percentage is bigger? 1.5 or 0.75? This percentage is bigger. In the fixed rate, you can see, and it's coming in the fixed rate. That means A is having a comparative advantage in the fixed rate. Let me write this sentence somewhere. Where should I write it? Okay, I will write it here. A is having, this method, by the way, you can apply anywhere all the time. 100% effective method you can apply all the time. Whenever you are in a doubt, when they don't clearly tell you which rate, they just give you both the rates and you don't know in which rate you have to swap. So this technique you have to use. A is having, you have to see the bigger gain, right? Under which rate they are having the bigger percentage, right? Benefit in the bigger. A is paying less, right? You have to see from that A's point of view. The company which is paying less, from that company's point of view you have to see, because they are benefiting, they are getting the competitive advantage, not the one who is paying high, right? So A is having comparative advantage in fixed cost, right? In fixed. rate. So what does it tell you? What does this tell you? A has to swap for A has to swap for A has to swap for what fixed rate? That's why we have to do this. Now we have understood that A has to swap for fixed means B has to swap for variable. So we got our thing. This is what we wanted to find out. So now we know that with swap and without swap what A and B will be doing, right? So now I'm going to again do the same method. All methods are same hereafter, right? A, no, without swap, with swap. So without swap, right? He is paying variable rate. I will put in bracket, and he is paying fixed rate. And the total is L plus 11.25. And here without swap, now with swap, I'm sorry, now we saw that A has comparative advantage in fixed rate, so he's paying at fixed rate. And he will be paying at variable L plus 1.5. When you add both, it will be L plus 10.5. Right? Now, one more thing is added here. Sometimes what happens is sometimes they tell you that find the gain and then commission comes later after you divide the gain, but this time they have taken the commission first, right? After taking the commission you have to take the gain, right? And commission is 0.15% for each, so I am also taking the commission now. 0.15, it is deduction, right? Because commission you have to pay, both together will be 0.3%, right? And it's a deduction. So now we have to find the gain, right? Earlier this commission part was not there. That is new in this one. And also we didn't know which rate to swap. That also we worked out here, right? Even under first method where we are actually given, if you check, there also we are having this comparative advantage, right? I will show you later after I finish this one. So what is the gain? 11.25 minus 10.5, it is 0.75, right? That 0.75 is the gain, but out of that 0.3 is going for commission. So 0.75 minus 0.3, 0.45 is your gain now, right? Now what will be your, and this gain needs to be divided equally. So it will be 0.225%, 0.225%. Now expected outcome, everything else remains the same, right? So expected outcome is your without swap minus gain. So L plus 0.75 minus 0.025, and here the expected outcome will be 10.275, because 10.5 minus 0.225, and if you add both you will get this, right? Now come to swap terms. Same, pay interest. That means with swap only. So with swap what are you doing? 9%, L plus 1.5%, L plus I'm sorry, this is in bracket, 10.5%. Now let's go to swap. What did I tell you? Start with floating, then fixed. right? So first floating is L only, and here net outcome will be same as yeah, your net pay, you can say. It is the same as your net outcome only, right? So you can see from both the company A is having L plus 0.525, B is just having 10.275. That means A is the one who is paying floating. Paying floating means L will be in bracket, and this company is receiving L, so without bracket. Solved. B companies at the end, the net outcome of B is in fixed, right? This is fixed, F. So when you swap the fix also, you have to start from that company, right? So L gets cancelled. 1.5 is there. You're paying interest at 1.5 and on net outcome 10.275. That means the balance is 10.275 minus 1.5. So it will be 8.625%. This is payment in bracket. This will be received. Two company, right? And one more thing you have to remember is if one company is receiving fixed, he cannot receive in floating also. He has to pay, right? It has to be payment and receipt. Let's say company A, when they are swapping, they cannot be paying floating and fixed at the same time. Either they are paying floating and receiving fixed, either they are receiving floating and paying fixed. It could be only one way. So that thing you have to remember. Now let's check whether this is correct or not. For A, right? You're paying at 9%. So 9 plus L plus 8.625. I'm sorry, minus 8.625. So yes, it is L plus 0.5275. This is correct. Second, L plus 1.5 minus L. So L gets cancelled. That means you only have 1.5 plus 8.625. Yes, 10.275. This is also correct. So this automatically will be correct, right? If you want to check further, if you want to take the gain and check, that also I can show you. Let's take without swap. Without swap, what was my position? L plus 0.75, L plus, no, this is not L plus, it was 10.5%. Now take the difference between without swap minus net outcome, right? So it will be, here it is 0.225% and here it is 0.225% and here it will be 0.45%. Are you getting the same gain? Just check. Go up and check. I will show you up. Are you? Yes. Same gain you are getting. You should get the same gain, right? The moment you are getting the same expected outcome, you should understand that you are on the right track. That's right. Now, I told you that for section question 1 also I will show you the comparative advantage, right? Let's see. Let me make this smaller. Yes, you can see good credit and second tier, right? So let's see fixed and variable. This is second tier, this is good credit G and this is second tier S. So good is paying at fixed, that is 11 and this is 12.5%. And this one will be L and this is L plus 0.5%, right? So in this condition also you can see that G is paying less under fixed also, under variable also. But which one is less? Like which one is they are having higher comparative advantage? We'll check. Right, just check the difference. 12.5 minus 11, 1.5. And here the difference is 0.5 only. So where are they having the higher? Again fixed. That means they have to swap fixed. Just see, are they swapping for fixed? Exactly, they're swapping for fixed. Just check this. With swap, it's fixed rate. So exactly, that's why they are getting this gain. If swap does not work that way, you will never get gain. That's why interest rate swap, even though it looks hard, it is the easiest. If you understand this method, it's the one of the easiest to score. Maybe you can score full marks also for this section. Make sure that you go through this and do it by yourself and check. So these are the two questions I have solved, and one more thing I want to solve here is this part, right? I want to solve this through a question. Wait a minute. It is how to value, right? How to value interest rate swap. Let me write the topic. I'm sorry, it just went. Okay. Valuing interest rate swap. This is the topic. Valuing interest rate swap, right? How are you going to value this interest rate swap? This is a small portion, but if it comes, right, I have seen once this question came up in the past paper when I was doing, I forgot the year of that past paper. It was in a mocks, in AFM mocks. In your BPP textbook, there were three mocks for AFM. Out of the three mocks, in one of the mock, I have seen this question. So that's why I thought of putting this in my video, because you might never know when it comes. So you should know how to value an interest rate swap, and it's easy. It's an easy thing. So I think I should have put, right. So an interest rate swap can be valued as the net present value of the net cash flows under the swap, right? At the start of the swap, the contract is designed to give a net present value of 0. Let me write the points. At the start of contract. Which contract? Swap contract. At the start of swap contract, the swap contract is designed to give net present value of 0. This you should know, right? Based on current FRA rates. However, the value of the swap will change as interest rate fluctuates. However, I hope you can understand my handwriting. Right, it's very bad, I know, but okay. Right? Now I'm going to explain this concept by doing a calculation. One calculation is only there, and that's it. We are done with the syllabus of AFM. After that, I can go and teach you the exam techniques. So, annual spot rates. Okay, this are by the way, this question is there. in your BPP textbook on page 485. The question is on 485. The answer is in 486. You can open the book. While you are seeing this video, you can keep your book open and see. Because I don't want to write down the whole question. It will waste a lot of time. I don't want to waste time writing the whole question. So I'm just reading the question from the book. Annual spot rate derived from the yield curve available to Saline Company. The company's name is Saline Company for the next 3 years. So for the 3 years, they are giving the spot rate. The spot rates are derived from the yield curve. Okay. So in the first year, 1 year, it is 3.5%. For 2 years, it is 4.6%, and for 3 years, it is 5.4%. Right? So if Saline Company wants to borrow for 2 years, let's say for example, if they want to borrow for 2 years, they will be able to borrow at 4.6% per year for the 2-year period. So now, before we value, right, we first have to find the FRA rate using this 3 spot rate. How are we going to find the FRA rate? So the FRA rate can be calculated from this data as follows. FRA rate for 1 year would be 3.5%, right? Because it is 3.5% here, you can see, for the first year. That means for 1 year only, not first year. For the 1 year, it will be 3.5%. But FRA, which is starting in 1 year and ending a year later, right? Starting in 1 year, that means after 1 year, and ending a year later, that means in the second year, will be calculated by comparing the borrowing cost for 2 years to the borrowing cost for 1 year. So the Meth formula is like this. Just take for this to second year, okay? So it will be 4.6, right? I'm sorry, 1.046, because 1 plus 4.6% to the power 2. You have to take it to the power 2 because it's for 2 years. Divide by, go back and check this. For the first year, it is 3.5. So it will be 1.035 to the power 1, because it's only for 1 year, minus 1, which will be equal to 5.71%. Now this will be repeated. So this you have to know, right? This will be repeated. Only the numbers will keep changing. If Saline Company wanted to have an FRA starting in 2 years and ending a year later, starting in 2 years means what? Starting second year, this year, and finishing on this a year later. Remember FRA rate? How FRA rate are given? 1V, 3, like this. Remember? Starting from 1 year, ending after 3 years, is like that same way. So FRA starting in 2 years, ending a year. This is how they will say. Right? FRA starting in 2 years and ending a year later. This would be calculated by the borrowing cost for 3 years to the borrowing cost for 2 years. So it will be like this. 1.054, because for the 3 years, and you have to compare with the previous year, that is 1.046 to the power 2 minus 1. This will be 7.02%. Right? And for the first year, it will be 3.5% only. 3.5%. So this, and this. These are the 3 FRA rates. Right? Now the question says, Saline Company has 100 million of variable rate borrowings repayable in 3 years' time, and is concerned about interest rate rises. Of course, it's a borrowing, so they will be care about interest rate rises. Now there's a swap. What is the swap? A variable fixed swap deal is being negotiated with whom? With a bank. This time, the swap is not with individual to individual like before we did. The other 2 questions which I did, individual to individual, 2 counterparties are there. Now this time is with the bank. The deal is with the bank. It could be an individual and a bank, right? Swap. And this is a variable fixed swap. So they are saying This will be based on paying the bank a fixed rate over the 3-year period in exchange for a variable rate less 0.5%. That means you are paying bank fixed rate, bank is paying you variable rate, right? You are paying bank fixed rate. For that, bank will be paying you variable rate minus 0.5%. Now, what are you required to do? You are required to estimate the fixed rate that will be paid as a part of the swap. What is that fixed rate which you are going to pay to the bank for the swap? That's what you have to find out. And always you'll be asked to find the fixed rate only. So don't worry about the variable rate, right? They will not tell you. So now this is how you have to do it. I'm sure the solution is there in your book, but as usual you will be confused, right? So let me sort it out. Okay. So the swap will be designed so that the bank makes a reasonable return. The bank will expect to at least make a net present value of 0 from the deal, right? You should always assume this. Bank will accept to make net present value equal to 0, right? So now the bank's expected payments, that means receipts to the company, right? See, bank is paying you means it's a receipt for you. Bank is paying you variable rate, right? So that will be a receipt to you at a variable rate, right? Are estimated using the FRA rates. We already know the FRA rates. So using that, we can find out the variable rates, right? So 1 year, 2 years, 3 years. What is the FRA? Just now we have calculated it. It was 3.5% and it was 5.71% and it is 7.02%. And here they are saying that variable is what? Variable minus 0.5%. So what is variable in this case? The FRA. So FRA minus 0.5%. Right? That means 3.5 minus 0.5, 3%. Here it will be 5.21%. Here it will be 6.52%. Now, that was in percentage. Now you want to find in millions, in dollar million. So this is for which one? It's 100 million of variable rate borrowings. 100 million. So in million, right? So once you deal in million, I will be showing you the working down. That means it is 3% into 100. So it will be 3 million. Same way, 5.21% into 100, it will be dollar 5.21 million. And here it will be dollar 6.52 million. Right? Now, bank's expected receipts. Payment by the company. That means what we are paying. What are we paying? We are paying at fixed rate. That is a receipt for the bank. So the bank's net cash flows will be what? Right? In dollar million. For 1 year, for 2 year, for 3 years. Right? What is that fixed rate? They are saying that fixed rate, let's take as R, capital R. You can take any letter, it doesn't matter. So this is the bank's receipt. Bank is going to receive this from us, right? So bank's receipt minus bank's payment. That will be that will be bank's net cash, right? So what is bank paying? Bank is paying variable rate to us, and we are paying fixed rate to bank. So fixed rate bank is receiving R minus variable rate, that is 3 million. Just now we calculated that 3 million is what is it? It is bank's payment. We are receiving, bank is paying it, right? Same, R minus 5.21 million, R minus 6.52 million. So this will be the net cash flow, because receipt minus payables is cash flow, net cash flow. Now we told that net present value needs to be 0. Net present value we need to discount. If net present value is there, that means this needs cash flows needs to be discounted. How are we going to discount? We have the spot rates. Exactly. We are not going to use FRA rate to discount it. Don't use this FRA rates. We are going to use the spot rate. What are the spot rates? I will take you up and show you. These are the spot rates. These are the spot rates. Using this, we are going to discount, not the FRA rates. FRA rates are we had to find the variable rate, right? So now, and it's time, let's say, and it's for 3 years, right? 1, 2, 3, and total net present value you need to find out. So net cash flow NCF is R minus 3, right? I'm not dealing with millions. Let's put R minus 3 here. I'm dropping off the millions, R minus 6.52. Now discount factor. First year it is 3.5%. Second year it is 4.6%. For third year it is 5.4%, right? So the total, when I discount, how will I discount? 1 over 3. So this I will, okay, I'm just showing you the first year. The other years you can do 1 over 1 point, wait, 1.035 to the power 1, right? Multiply this by R minus 3, right? So when you multiply this, you will be getting 0.966 R minus 2.898. The same way for here we are getting 0.914 R minus 4.762. And for the last one we are having 0.854 R minus 5.568. What do you have to do in the total net present value? Add all this 3. Add all the 3. You'll be getting 2.734 R minus 13.228, right? And when you have to find R, we know that net present value is 0, right? So 2.734, right? R equal, okay, well, I will write it here. 2.734 R equal to 13.228, because the equation is equal to 0. That's why we are taking 13.228 to the other side. So R will be 13.228 divided by 2.734. R is 4.838%. If you are not sure of this answer, take this percentage in your R formula and put it and see, are you getting 0? You have to get the total net present value as 0, right? Even in the percentage, even in millions, you'll be getting 4.838 only because it is 100 million, right? So this is your R. That's what we have to find out. Even there's a technical article on ACCA website determining interest rate forward and their application to swap valuation. You can read that article if you want to get an understanding. So that's it about interest rate swap and how to value an interest rate swap. I hope by now, by the end of this video, you will be mastered in this, right? So now interest rate swap will be nothing for you. Comment me below if this video has really helped you, right? So my next video, I this video itself is about 1 hour, so I will put it in my next video. The last part, I have finished all the articles, all the technical knowledge of AFM. I've covered whatever things you need to cover, so please go through them. And last video is about only exam techniques, which needs to be applied on the exam day. That I'll be making shortly. And then after this video, right after this video, I'll be uploading it shortly. So take care and best of luck.